My name's Tim Atkin, and together with my colleague Isabel Hartstein, we want to take you through some work that we put together with another colleague, Jarkko Jeskela, on the determinants of the Australian dollar recently. So Isabel and I work in the foreign exchange dealing and analysis team. And for me, I've been at the Reserve Bank for 10 years now, and I've managed the team responsible for the analysis of the Australian dollar since the start of 2020, which has been a really interesting period. Isabel joined the bank as a graduate in 2018 and is now one of our senior analysts looking at developments in foreign exchange markets. And so I know that for me anyway, FX markets are one of the most interesting areas of the financial markets world. You grow up hearing about the Aussie dollar on the news each night. We buy or sell currencies to use on that overseas trip or before COVID when we're able to travel. And from a broader perspective, the exchange rate also plays an important role in the competitiveness of our economy. But I think what I find most interesting is thinking about what drives moves in the exchange rate and what news they react to. And this is really where we want to focus on today. So to kick us off, I just want to take a look at what the Australian dollar has actually done over recent years to provide some perspective and context. So this chart here shows two key measures of the exchange rate from around the early 2000s. The red line shows the Australian dollar against the US dollar, and the black line shows the trade-weighted index, or the TWI. And this essentially measures the Australian dollar against a basket of currencies based on our key trading partners. So I think there's a few broad trends or things to pick up from this chart. The exchange rate appreciated for much of the decade from the early 2000s through to its peak. And this largely reflected the effects of the mining boom. From then, it has depreciated as commodity prices have come off and as monetary policy has been eased. And so I think the other thing that you'll notice there is that there's two sharp spikes down. One around the global financial crisis in 2008 and the other at the height of the COVID crisis in March last year. And so while it's appreciated since that point, it remains well below its 2013 peak still. And so what we want to do today is outline some of the key determinants behind these longer term movements in the exchange rate, as well as highlighting some of the shorter term factors that we also know play a role. So just a short outline to help guide us through the presentation today. I'll focus on introducing the key determinants. And as part of this, I'll dive a little deeper into the role of monetary policy and interest rates. After that, I'll hand over to Isabel to take you through commodity prices and the terms of trade, as well as looking at some other factors such as risk sentiment that also influence the exchange rate. So jumping straight into it, on this graph, we have the exchange rate in the top panel, and in the bottom panel, we have the terms of trade and interest rate differentials. And we see these as the two key determinants of the Australian dollar over the medium to longer run. So the terms of trade, or the blue line there, is the ratio of export prices to import prices. And you can see that it increased over the early 2000s, hitting its peak at the height of the mining boom, before declining over a number of years. More recently, it's jumped up a bit again, and Isabel will talk more about this and commodity prices later on. The interest rate differentials, or the yellow line here, are the other key determinant. And this is the difference between interest rates in Australia and interest rates overseas. And you can see that after being at a relatively high level over the first part of the 2000s, this has also declined over the past decade or so. So I think a question that kind of comes up from this is, why do we think about these factors as key determinants? And will both of them provide information about the expected demand for Australian dollars? And we typically expect a positive relationship between these factors and the exchange rate. And so just to highlight this, a couple of quick examples. If the terms of trade were to increase, we'd expect the Australian dollar to appreciate. And if interest rates in Australia increased relative to those overseas, we would also expect the exchange rate to appreciate. I think the nice thing about this graph is that it shows this broadly playing out as we might expect. And another important thing about these relationships is that they've been observed over long periods of time. And so because of this, they also feature pretty heavily in our exchange rate models. And so the idea here is that we should be able to combine these factors together into a model and get an estimate of what the exchange rate should look like. And this graph here shows some of our estimates from our forward-looking model of the exchange rate. And so you can see the model estimates or the red line here. They're based on those key determinants that I just mentioned and that we just saw in the graph before. So the model uses forecasts of the terms of trade and interest rate differentials from across the yield curve. And you can see that for the most part, it does a pretty decent job at capturing those broad trends. It shows the appreciation over the first part of the 2000s and the subsequent depreciation that's occurred over the past decade, as well as picking up some of those other moves too, particularly around the GFC period. So while these things are never perfect, it gives us a pretty good guide of what we should be expecting. So with that as background, what I want to do now is spend a bit more time focusing on the first of these key determinants. So looking at the role of monetary policy and interest rates and thinking about what matters for the exchange rate in this space. So the structure of interest rates, or the yield curve, affects demand for Australian dollars, and as a result influences the exchange rate. Yield curves capture information about expectations for the future path of monetary policy, particularly in the shorter term rates, and it also captures information about expectations for inflation and economic activity in the longer run. But as I mentioned before, and probably the key thing here, it's not just interest rates in Australia that matter for the exchange rate, but it's actually the difference between interest rates here and interest rates overseas. And so again, just to help highlight this, a couple of quick examples. If interest rates in Australia fall relative to those overseas, then the returns that investors receive on Australian dollar assets become less attractive. There's less demand for Australian dollars, and this puts downward pressure on the currency. But in another example, if interest rates in Australia fall, and so do interest rates in other economies, then the difference between interest rates here and those overseas, or the differential, will be little changed. And so in this example, there'd be little incentive for investors to shift their money elsewhere, and we wouldn't expect much of an effect on the exchange rate. So with this background, I want to take a look at what some of the key trends in interest rates have been over the past few years. And starting off by looking at central bank policy rates, so the rate that the RBA sets. We've included rates for Australia and those in the US, Japan and Euro area, or what we call the G3. I think one of the features of this graph, so one thing you'll notice, is the fall in policy rates right after the GFC. So almost in the middle of the graph here. And you can see that policy rates basically went to zero for these big economies, while in Australia they remained a fair bit higher. And so higher rates here were related to how well we did coming out of the GFC compared with these other economies. And this was partly because of the effects of the mining boom, and partly because we didn't see the same type of financial system stresses that occurred overseas. But as we continue kind of left to right, you can see that monetary policy in Australia has been eased over a number of years now, and the policy rate is been lowered and is currently close to zero. So this has flowed through to a decline in other interest rates in the economy, including government bond yields. And this all happened while rates in the major economies have remained at or around zero. So what does this mean for the Australian dollar? Well, the interest rate differential between Australia and these other economies has declined over this period. And we can see this here if we focus in on the period since 2013. This graph shows the interest rate differential on 2-year government bond yields between Australia and the G3. And I've also included the US on here because it's another important benchmark. We know that these shorter term interest rate differentials are important for the exchange rate. And you can see that they've declined pretty consistently over this period. Essentially, Australian rates have gone from being almost 3 percentage points higher than those overseas to being around similar levels as these shorter term rates have followed the cash rate lower as monetary policy has been eased. And it's this decline in interest rate differentials that's been one of the main drivers behind the depreciation of the Australian dollar since its peak in 2013. Okay, so a slight shift now to another key development that's occurred over this period. And this is the use of unconventional policy measures. And I want to talk a bit about quantitative easing, or QE, and the exchange rate. So as policy rates reached very low levels, unconventional policy measures such as QE have become much more commonplace and are talked about much more frequently. And in very basic terms, QE involves the central bank purchasing government bonds in the secondary market with the aim of lowering longer term interest rates. And in turn, this also affects the exchange rate. So how does QE flow through to the exchange rate? Well, when we look at the literature, there are 2 widely discussed channels that are often highlighted. The first of these is the signalling channel. So the announcement of QE and subsequent bond purchases underlines the commitment of the central bank to hold policy rates at a low level. So essentially, it just reinforces expectations for a low policy rate into the future, and this flows through to lower, longer-term interest rates. The second channel is the portfolio balance channel. And so when the central bank purchases government bonds, this increases the price of these bonds and yields decline. And so if you're an investor, these lower returns might encourage you to buy other assets, essentially rebalancing your portfolio away from government bonds and towards other assets with higher returns. And so thinking about the exchange rate in all of this, if investors choose to rebalance their portfolios towards offshore assets, this could see the exchange rate depreciate. And so overall, looking at the experience of other central banks, there's a broad consensus that these QE-style programs lower interest rates and contribute to the exchange rate being lower than otherwise. And while it's hard to measure, you can essentially think about the effects of QE as being conceptually similar to that of an easing in conventional monetary policy. And that is, it lowers interest rates and leads to a depreciation in the exchange rate, all else equal. So shifting focus a little bit now, moving on to Australia and the introduction of QE here, the RBA introduced a bond purchase program in November last year. This involved purchasing $100 billion of Australian government bonds over a period of about 6 months. And it complemented the package of policy measures that we introduced earlier in 2020. Since then, the RBA has announced additional rounds of government bond purchases as it continues to support the Australian economy. And so, as I mentioned earlier, these bond purchase programs typically focus on longer term interest rates. And I think it's helpful to look at what was happening with these rates before the introduction of the program to help provide some context. So this chart here shows the interest rate differential on 10-year government bonds, and zooming in on the period before the introduction of the program, so between March and September last year, so on the left of the chart there, you can see that longer term interest rates in Australia were higher than those overseas. And this is highlighted by those differential lines for the G3 and the US sitting above zero for that period of time. And this happened as other central banks introduced new or expanded versions of their own asset purchase programs in response to the COVID crisis, which put downward pressure on their longer term rates. And so with higher rates here compared with those overseas, this contributed to upward pressure on the Australian dollar exchange rate. It wasn't really until around September last year that markets started pricing in the possibility of a QE style program in Australia. And this is when we started to see a decline in these differentials. And I want to focus a bit more on the introduction of the program and combine a couple of these concepts together now. And so I think this graph provides a helpful picture of how things evolved from around the start of September last year. In the top panel, you can see the Australian dollar. And in the bottom panel, we have interest rate differentials for 2-year government bonds and 10-year government bonds. And the vertical lines there highlight the key announcement dates for the program. So I think the first thing to focus on here is that bottom left part of the graph. And you can see that in the lead up to the announcement of the program in November, which is highlighted by that first vertical line, the market anticipated some policy easing by the RBA. The interest rate differentials for 2-year and 10-year government bonds declined from the start of September to early November. And right above that, in the top panel, you can see that the exchange rate depreciated over this same period. So this is consistent with that idea that a decline in interest rate differentials is associated with the depreciation in the exchange rate. But as is always the case, there were other things going on in markets at that time too. And so while commodity prices were little changed, US equity prices did fall as risk sentiment declined. And so this could have also contributed to the depreciation. And as we move from left to right on the graph, you might have already noticed that following the introduction of the program in November, the exchange rate actually appreciated. And this was because commodity prices increased strongly and sentiment about the global recovery really started to improve from this point. And Isabel will talk more about this soon. So with all these different developments happening, it makes it quite hard to measure the specific effect of the bond purchase program on the exchange rate. But despite all this, and while there's a high degree of uncertainty around estimating the effect of the program, different models do suggest that the RBA's policy measures have contributed to the exchange rate being lower than otherwise. And this is also, I think it's important to note that this is also consistent with findings from the international literature too. So I think the most important things to take away from this section of the presentation are that the easing of domestic monetary policy over the past decade has been a key driver of the depreciation of the Australian dollar. And the introduction of QE more recently has contributed to the exchange rate being lower than otherwise. And so with that, I'll wrap up my part of the talk and hand over to Isabel to talk you through commodity prices and the terms of trade, as well as the role of risk sentiment.
Thanks, Tim. So as Tim has already mentioned, higher commodity prices are associated with a stronger Australian dollar. And this reflects the fact that commodities account for a large share of Australia's exports. This is not unique to Australia. Other advanced economies with large commodity export sectors, such as Canada and New Zealand, also have currencies that are linked to commodity prices. So changes in commodity export prices flow through to changes in the terms of trade. From an empirical standpoint, we find that the terms of trade work well in our model of the Australian dollar. To reiterate, the terms of trade is the ratio of Australia's export prices to import prices. If the terms of trade increase, we can purchase more imports for selling the same basket of exports, which reflects an improvement in real purchasing power and national income. So on the graph, what you can see in the top panel is the Australian dollar TWI and our internal forecast of the terms of trade. In the bottom panel is the RBA index of commodity prices. This index weights the price of each Australian commodity export by its share of total exports. So, for example, iron ore accounts for 30% of the index. As you can see, changes in commodity export prices strongly influence the terms of trade. And typically, an increase in commodity prices and the terms of trade is associated with an appreciation of the Australian dollar. Likewise, a decline is associated with a depreciation. So the clearest example of this relationship was during the mining boom from around 2005 to 2013. Australia's terms of trade increased significantly alongside global demand for commodities. These developments led to large inflows of foreign capital into Australia to help fund an expansion of capacity in the resources sector and pay Australian workers. This increased demand for Australian dollars, and so there was an appreciation of the exchange rate. Also, the demand for Australian labour contributed to wages growth and inflation, and generally a more positive outlook for the Australian economy. Now, since 2013, broadly speaking, the Australian dollar has depreciated and commodity prices have come off those very high levels. But this relationship is not always perfect. And over recent years, the relationship between commodity prices and the Australian dollar has at times appeared weak relative to history. So one simple way to illustrate the strength of the relationship between the Australian dollar and commodity prices is to look at the correlation. On this graph is the correlation between weekly changes in the Australian dollar and the RBA's index of commodity prices on a one-year rolling basis. It moves around, but there is a positive correlation. So when commodity prices increase, the Australian dollar also tends to increase. But over late 2017 through to 2019, the correlation in fact declined to around zero, which tells us the Australian dollar and commodity prices were not moving together through this period. Indeed, recently, we have also observed very high commodity prices and little response from the Australian dollar. So why might this be? Well, it is important to consider the nature of the commodity price shock. Is it temporary or persistent? If commodity prices are driven by relatively long-lasting shifts in demand and supply, then we are more likely to see a response in the economy, for example, through investment in the resource sector. In contrast, commodity price movements related to temporary factors, such as supply disruptions, are less likely to influence the exchange rates or the medium-term economic outlook. A persistent demand-side shock may also be associated with an improvement in the global economy over the medium term, which supports commodity prices, risk-sensitive assets, and the Australian dollar. Also, we need to consider what other variables are affecting the exchange rate. Most importantly, monetary policy here and overseas, as Tim has talked about. If policy rates are declining in Australia while commodity prices are rising, on balance, we might see the Australian dollar depreciate. So let me give an example of how we can use these points to guide our thinking. Over the past few months, you may have noticed that the iron ore price increased significantly while the Australian dollar, in fact, depreciated. While this might seem inconsistent, it could have partly reflected the expectation that the very high iron ore price would not persist. And so the investment intentions of mining companies in Australia did not change. In fact, the iron ore price has now declined to around where it was at the start of the year. Moreover, interest rates in Australia have declined relative to those in the United States following the June FOMC, or Federal Reserve meeting, which supported the US dollar relative to a number of currencies. So, continuing to look at the iron ore price, we can also consider a few other recent examples. In this graph is the change in the iron ore price, decomposed into three categories using our commodity factor price model. On the left-hand side is the increase in the iron ore price over 2019, decomposed into moves that are specific to iron ore. So those are the yellow bars. Moves common to bulk commodities, so iron ore and coal, and represented here by the green bars. And moves that are common across all types of commodities, here, the blue bars. So in 2019, we saw an increase in iron ore prices that was largely specific to the iron ore market. And that lines up with the significant supply disruptions in Brazil and Australia at the time. Because these price movements were expected to be short-lived, they did not lead to large increases in capacity or production by Australian producers. As a result, the exchange rate did not move closely with commodity prices over this period. So let's contrast 2019 with the second half of 2020, when the Australian dollar did, in fact, appreciate alongside higher iron ore prices. At the end of last year, the iron ore price increased alongside a range of commodities, which is captured by the blue and green bars on the right-hand side. This broad-based increase in commodity prices was related to improving expectations for a recovery in global demand. The medium-term outlook for the Australian economy also improved, and we saw the Australian dollar appreciate alongside higher commodity prices. All right, so far we've discussed how monetary policy and commodity prices affect movements in the exchange rate. But other short-term factors can also play an important role. In particular, I want to discuss the role of risk sentiments in the foreign exchange market. We know that global risk sentiment affects asset prices, and the Australian dollar is no exception. In part, this reflects the fact that over several decades, Australian financial markets, including the foreign exchange market, have become more closely integrated with the global financial system. So international developments matter for the Australian dollar. The Australian dollar is today the fifth most traded currency globally, and around 90% of turnover in the Australian dollar occurs overseas. Market commentators often link the exchange rate to the outlook for global growth and describe the Australian dollar as a risk-sensitive currency. This is because the Australian dollar often appreciates when risk sentiment and the outlook for global growth improves. But more importantly, the Australian dollar is also known to depreciate sharply when risk aversion is high. Each episode of risk aversion can have different underlying drivers and occur amid different macroeconomic circumstances, but usually the Australian dollar depreciates. Risk sentiment itself is not directly observable, but changes in risk sentiment are typically associated with asset price changes across a range of financial markets. One way to highlight the role that risk sentiment plays in influencing the Australian dollar is through its correlation with prices of other risk-sensitive assets, such as US equities. You can see in the top panel of the graph how the Australian dollar and S&P 500 moved together very closely last year. The bottom panel shows the correlation between weekly changes in those two series on a 6-month rolling basis, which again just emphasizes the very strong relationship over 2020. Generally, price movements in equity and currency markets may align because both markets respond to the same information about changes in the outlook for risks and global growth. During the height of the financial market stress in March 2020, the Australian dollar depreciated sharply to 55 US cents, which was its lowest level since the early 2000s. This was also a period in which we saw the value of equities decline sharply. One reason the Australian dollar depreciated in March was because of strong demand for safe haven currencies, including the US dollar or assets denominated in US dollars. These are assets that tend to increase in value when markets are volatile or uncertainty among investors is high. This demand meant the US dollar appreciated, and we also observed an appreciation in other safe haven currencies, including the Japanese yen. After the sharp depreciation in March, the Australian dollar appreciated and equity prices rebounded as conditions in global financial markets improved. The correlation between equities and the Australian dollar remained high through much of 2020, but has declined a bit into 2021. So that brings me to the final slide. Today, we have highlighted two of the key determinants of the Australian dollar over the medium term. In particular, monetary policy and interest rate differentials, along with commodity prices and the terms of trade. These determinants have driven the depreciation in the Australian dollar since around 2013. And more recently, the introduction of QE here in Australia has contributed to the exchange rate being lower than otherwise. We also briefly covered risk sentiment and highlighted the important role it has played recently. This framework is not particularly new. These variables have been a key focus of currency analysts for a long time. But what we have observed over recent years is that the nature of these variables can change, and so can their relationship with the Australian dollar. So I hope you have found this presentation interesting, and I hope it is helpful for you when thinking about movements in the Australian dollar.